Okay, so today we're gonna start the IAS 36 impairment of asset. Fine. And what does impairment means? Impairment is a reduction and recoverable amount. So this is actually the reduction and recoverable amount of an asset or cash generating unit below its carrying amount. Let's say if we have here, this is the carrying amount, okay, and here we have just a recoverable amount, okay. The carrying amount is, let's say, 500 and the recoverable amount is 400. So we have here is a reduction and the recoverable amount below its carrying amount, and here we have a deep impairment loss of 100. Clear? Now IAS 36 impairment of assets says that entity should carry out impairment review. So we should go for impairment review at least annually if the intangible asset is not being amortized because the life of the asset is indefinite, okay. And the second thing is goodwill. The goodwill that has come because of the business combination. So we purchase goodwill. For that you will go for yearly impairment review. Otherwise impairment review you should go for impairment review when you have indication for impairment, okay. So here we have discussed two things. The first thing we discuss about the impairment, that what does impairment mean, and the second thing we discuss that when we go for impairment review. So when the intangible asset, the asset which intangible asset which is not being amortized because their useful life is indefinite and finite. And the second thing is goodwill, which is come due to purchase. So that for that you will go for an annual impairment review. Otherwise you will check the indication. If there's indication, then definitely you will go for impairment. Otherwise, no need. Now the second thing we have here is let's move on. Clear. Let me show you that what is the difference between impairment and depreciation. So impairment and depreciation, there's a difference between these two terms. The first one is the systematic allocation of cost or its useful life is called depreciation, while impairment is a sudden fall in value of an asset. So depreciation is a systematic allocation of cost, while depreciation is actually the systematic allocation of cost or its useful life. What does the systematic allocation means? Let's say we have asset and the asset cost is let's say 1000 and useful life is let's say 10 years, okay. So the depreciation for the year one will be like this: 100,000 divided by 10 and you will get 100. So this is the systematic allocation for 1 year, 2 year, 100, like this, okay. And if you check the impairment, then it's a sudden fall in value. Let's say the value of the asset is let's say the value of the asset is carrying let's say 1000, and there's some you get some hand from let's say from worse economic environment, then the asset goes down to 900. So this is not a systematic, this is sudden fall in value. So we call this sudden fall of value. So when there's sudden fall of value, then we call this impairment. Well, if we have to do some systematic allocation, then we call that depreciation. Clear? One thing more, we never do impairment directly. First we get hand, okay, hand for impairment, and then we go for impairment testing, and after that we get result, okay, that is whether it is impairment or not impairment. Clear? The hand, it may be internal, it may be external. Internal means damage to the asset, change in the use of asset, and plan to sell an asset. So if you have this hand, then it means this is the indication, this is the indicator that tell us that okay, we should go for impairment testing. Clear? And external hand, it may be technology, change in technology. Okay, it may be change in the legal and economic environment, or increase in interest rate, and carrying value of asset is greater than market capitalization. Market capitalization means that total number of share multiplied with market price. So if you have this hand, then you will do impairment testing. Clear? Let's move on. We have some other thing, and this is just a theory. Okay, the indication theory, that indication of impairment. IAS 36 lists the following indication that an asset is impaired. The first one, unexpected decrease in the asset market value. So when there is unexpected decrease in the asset market value, then it is the indication that the asset is impaired. The second one is significant adverse changes that we have discussed earlier in the technology, market, economic or legal environment. Interest rate is what we have already discussed, and the net asset are measured at more than its market capitalization. We have already discussed this. 2. Now internal sources of information is evidence about the damage. Okay, now a material reduction in the usage of asset, evidence economic performance of the asset has been or worse than expected. So these are the indicators which tell us that the asset has been impaired. Okay, now we have just moved on that how to calculate the impairment losses. Okay, so impairment occur when the impairment occur if the carrying amount of an asset is greater than its recoverable amount. I told you before that let's say we have carrying amount 500, okay, and this is the recoverable amount which is 400. So the carrying amount of an asset, which is this amount, is greater than recoverable amount. This indicates that impairment has been happened. This is by 100, impairment by 100. Okay, and what does recoverable amount means? Recoverable amount is actually higher of fair value less cost to sell and value in use. So mean we have here recoverable amount, and this will be higher of 2. Number one is fair value less cost to sell, and the second is value in use. Let's say we have here 500 and here we have 600, so the recoverable amount will be 600. Clear? And this will compare with the carrying amount. Clear? Now what does fair value means? So IFRS 13 fair value measurement gives some definition, and that is the price. Fair value will be the price received when selling an asset, an orderly transaction between market participant at a measurement date, that will be the fair value. The price received when selling an asset, in orderly transaction between market participant at a measurement date, so that will be your fair value. Clear? Cost to sell, what does cost to sell mean? We have discussed here that fair value minus cost to sell, and this is the higher of recoverable amount is higher of fair value to cost to sell minus cost to sell and value in use. So what does cost to sell means? Cost to sell means the incremental cost directly attributable to the disposal of an asset. So means this is actually the incremental cost, okay, which is directly attributable to the disposal of an asset. And we want to dispose some asset, and there will be some anchored some cost. That cost will be cost to sell. Okay, and now this amount will be deducted from the fair value. Okay, value in use means value in use is actually estimating future cash inflow and outflow from the use of the asset and its ultimate disposal, and applying a suitable discount rate. So that will be, let's say we have here this is the inflow and we have discount rate at 10%, so we write 0.09 and we multiply this value to get some amount that will be our value and use. Move on, we have just carrying out how the impairment testing is carrying out. So carrying amount, here we have carry out impairment testing. So we will compare two things. The first one is carrying value and the second one is recoverable amount, and recoverable amount is the higher of fair value less cost to sale and value in use. Let's say we have here 6,000 clear, and we have here 300, and here we have 500. Okay, so first we will take recoverable amount. Recoverable amount is higher of these two, and here the higher one is 500, and then we compare the 500 with this 600 and it will show us that the asset is impaired because carrying amount is greater than recoverable amount. Clear? Okay, a fair value less cost to sell is higher. Okay, what does it mean? It means that if this amount is greater than this amount, then no need for calculating this value in use. Because there is no impairment. Let's say we have here 6,000 and here we have 700. So this means that the asset is not impaired and there is no impairment. So no need for calculating the value in use. Okay. One thing more, okay, when we have some binding sale agreement, so the bid price, the bid price is relevant instead of fair value, because the bid price is the relevant instead of fair value. When there is non-transferable asset, the asset which is not transferable, so the fair value is irrelevant. When okay, the future capital expenditure and their related revenue is irrelevant in the computation of value in use. Always ignore interest and tax cash flow. For value in use computation, take cash flow for the next 5 years only. So we have to just limit our expectation, and for that reason we have just to take the 5-year cash flow only. Then we use the decreasing growth rate for calculation of future cash flow. If the whole industry, let's say if the whole industry is booking the impairment, okay, and we are not booking the impairment, then we should disclose that why we are not booking the impairment. So thumb rule is whenever carrying value is greater than recoverable amount, impairment is must. Carrying amount, let's say this is the 300 and recoverable amount is 200, then impairment is must. Okay. Then we have to, okay, which discount rate should be used. So for that, the first thing you should remember that project specific discount rate is used. Okay, if there is no project specific discount rate, then you should go for market interest rate with inclusion, okay, currency risk, country risk, etc. And the second third thing is on current WACC. So I mean there was a question in the first paper where the examiner was asking that a company which are using WACC which was not current year WACC but before maybe 2-3 years back, so we should use a WACC but the current WACC. Okay, now difference between a revaluation and impairment. So revaluation is actually an option and revaluation losses is assumed losses. Impairment loss is the genuine losses, and the second thing is it must even be used if using cost model. So revaluation is just when you are using a revaluation model, while impairment you are using both if you are using cost model or revaluation model impairments. Okay, impairment losses is genuine losses. Then move on, we have some technical things, and that is about reversal of impairment. Okay, Let's say we have some, okay, there are two models we will use. The first one is cost model and the second one is revaluation model. So the reversal of impairment is possible till the extent of historical carrying value. Means the reversal, this is the borderline, this is the, you should not cross that line, okay. And the carrying value, okay, and this historical carrying value means that if there had been no impairment in the past. Clear? We will do some question on this. The second thing is revaluation. In revaluation model, if you are using revaluation model, then the reversal of impairment is possible to the extent that you have booked expenses in the past with inclusion of the effect of reduced depreciation. Okay. So the reversal in cost model, you have some borderline. You will not you will not cross that borderline, and that borderline is just as the historical carrying value, and the historical carrying value is actually the carrying value if there had been no impairment in the past. Clear? Let's move on and do a question from the book, and that is the test your understanding impairment of asset. Impairment is question. First we should go for the requirement. Requirement is discuss the accounting treatment of the above and financial statement for the year in 31st December 2001. And the second requirement is how would the answer to be a part, this part, how if there is, let's say the question is actually is that if there is 10,000 and other component of equity relating to the that specific asset, a revaluation, so how you will treat this. Now on the 1st December 2001, okay, entity noticed that one of the item of the plant and machinery is upon left idle, okay. On this date, the asset had a carrying value amount of this, so means on 31st December 2001 we have an asset and the asset carrying value is 500. Clear? And the fair value, this given the fair value is 3. Okay, now the fair value is 325,000. An estimated cost to dispose the asset is, so that we will deduct this amount, and this is 25,000, okay, and it will be like 300,000. This is the fair value less cost to sale, less cost to sale. Now if the asset is not sold, okay, now if the asset is not sold, then the entity estimates that it will generate cash inflow of 200,000 and each of the next 2 years. So means we have some cash inflow, and that is 200,000, and this is for year 1 and this is for year 2, okay. And then we have some the discount rate, and the discount rate is 10. So here we have discount rate, and we will apply that discount rate here, and here we will have some value and use. This value and use we will, and this fair value to cost, we will take higher up, and that will be our recoverable amount. That recoverable amount we will compare to the carrying value, and then we will get some impairment of the asset. So let me show you here. If you see here, the value in use is calculated as the present value of the asset of the future cash flow, and this is year 1 and year 2. This is the cash flow, and this is the discount rate, and that is 10%. We will have this amount. This is the value in use, okay. So the recoverable amount, we know that recoverable amount is the higher of the fair value less to cost to sell, and the fair value is 325 and cost to sell is this amount, so it will become like this 300,000. We will compare 300 with this amount, and we will take the higher, and the higher amount is the value in use, okay. Now this value in use, which is this is the recoverable amount. Now value and use the higher amount. So this will be our recoverable amount 3247, and our carrying amount, which is K1, is 500. So this carrying amount is greater than recoverable amount, so there is impairment of 153. This is the impairment loss, and we will book this, and the profit and loss is a debit profit and loss with 5153 and credit our PPE by 1P3. This is the answer to the part 1. Now the part 2 is asking that if we have some revaluation reserve, here you see, how would the answer to part A be different if there was a balance of $10,000 and other component of equity relating to the prior revaluation of this specific asset? So if we have some revaluation reserve for that asset and the other component of equity, so how we will treat this? This is the very simple. First, what we will do, let me check it, remove this one. Okay, let's say we have 10,000. So it's very simple. The asset will be written down to by that amount, that is 153. This is written down by 153. So it means that credit PPP will be 153. Fine. But first debit will be revaluation reserve by 10, which is already the balance. Okay. And the third thing that we will do is profit or loss. So some expenses have been recognized in the profit and loss, and the other one is revaluation reserve, because we have already revaluation reserve and other comprehensive and other component of the equity. So we will first charge this 10,000 here, and the remaining will be goes to the profit on loss and expense. Now let's move on. Let's talk about some cash generating units. So cash generating unit is actually the smallest group of assets that generate independent cash inflow. So mean the smallest group of assets that generate independent cash inflow. Okay, a step for the allocation. If we have cash generating unit and there is the impairment loss arises because of the cash generating unit, then how you will allocate the impairment loss to the cash generating unit? So the first thing is the obvious impairment, mean the asset which is destroyed completely. So first you will charge that. After that you will go for the goodwill, and the remaining will be on pro rata base. Okay, this one thing you have to remember, that never ever impair cash and current asset. Okay, we have here, if the carrying amount of the asset cannot be reduced below the highest. Okay, so the carrying amount of the asset cannot be reduced highest of this fair value less cost to sale, value in use, and nil. Okay, so I mean the carrying amount of the asset cannot be reduced below these higher of this. Okay, let's move on. We have some question, and that we will do some question of them, then we will okay, here's a question for CGU, impairment allocation within CGU. So how is the impairment loss allocated to the asset within the cash generating unit? So we have some cash generating unit, and that is the CAP has identified impairment loss. This is impairment loss of 41 million of 100% cash generating unit. The carrying amount of the unit, the carrying amount of the unit of the net asset was 1,450. So means that the carrying amount is 150. Okay, and we have impairment loss of this amount. Clear? Means that this amount is greater by that amount, 41,000, which is the impairment loss, where the unit recoverable amount is 109. So 109 and 150, the difference between 109 and 150 will become 41, and this is the impairment loss. This is the recoverable amount. So this is the raw value here. This is the goodwill, property, machineries, vehicles, patent, and non-monetary asset. So this net non-monetary asset should be not impaired. Okay, we don't need to impair this. That will be like this. Goodwill will be completely written down. Okay, other things we will check. So the net selling price of the unit sale is insignificant except property. Property had a market value is this 35,000, and the net monetary asset will be realized in full. So means here if you see the property value is 20, the carrying value is 20, and recoverable amount is 35. So there is no impairment. So this amount will also be same like this. Okay, no need for impairment. Let me write here I will write goodwill, and then we will write property, then we will write machinery, and then vehicle, and then patent, and then net monetary asset. Okay, goodwill value is 13, then 20, 49, 35, 14, 19, and that will become 150. So there is a 41 is impairment, 109 is the recoverable amount. This amount, the whole amount will be written down, so it becomes 0. This one is no need because the carrying amount is less than recoverable amount. This amount 19 will go the same like this. Clear? So okay, fine. Now the remaining will be on pro rata base. Okay, so here if you see, let me show you, this is the goodwill. The whole amount is, you see, firstly impairment loss is allocated to the goodwill, reducing its carrying value to nil. So the carrying value is reduced to nil. Second thing, the impairment loss cannot sit against the property. We have not set the impairment loss against the property because the property carrying value is less than its recoverable amount. So we write the same thing, 20 carrying. Fine. This is the second description for the second thing. Now likewise, impairment loss cannot be set against the net monetary asset. We should not set impairment loss against this because this is realized in full. Okay, 19. Now the balance of the impairment loss, which is 28, because 41 less 13, okay, will be 28 because we have just put we have just written down it to nil because in goodwill, and the remaining amount is 28. Now the 20 will be a portion remaining set, and its formula is the same like this. This is 28. So the total asset we will calculate here is 49 and 35 and 14. These three will be added up. Okay, and the remaining is okay. The 13 is reduced to nil. This one is be the same because it's not unfair, and the pattern, okay, sorry, and in the non-monetary is no need for this impairment because it will be realized in full. So it you will write this amount. Let's say we have to calculate impairment for vehicle, so we write 35 and then 49 plus 35 plus 14 and multiply with this impaired amount, so that we will get here 25 and 35, that like this. Okay, fine. I think okay, so here we have another question, and the question is discuss with calculation how the impairment loss will be accounted for. So there was exposure in the factory. The carrying amount of the asset were as follows. So this is the carrying amount of occasional units. Okay, the goodwill is 100, patent 200, machine, computer, building, etc. The factory operated as a cash unit. Impairment review reveals that the net selling price of 1.3 million for the factory, okay, and the value in use is this amount. Okay, fine. Half of the machine have been blown to pieces, but the other half can be sold at least at their carrying value. The patterns have been superseded and now, so this is the obvious impairment. Okay, so what you will do first, you will do there is impairment. How much impairment is okay, just check it here. The drop value is 100, clear, and the pattern 200, which is completely blown, superseded, are now considered worthless. So we will consider this to nil. Machine is, how much machine is 300. Machine is 300. Okay, okay, so the pattern have been superseded and have recoverable amount of nil dollars, therefore should be written to nil, and the impairment of 200 must be charged to profit or loss account. Clear? Now if you see here, this 200 will be charged to profit or loss because superseded, so we will record this as a nil. And then if you see here that half of the machine have been blown into pieces, the machine value, the actual amount is 300, so half will become 150. 150 is gone, so we will reduce this to 150. The other thing is okay, and let's just check and the theory what is actually the thing is. So here the pattern have been superseded. Okay, this is fine, we have done with this, and half of the machine have blown, so therefore half of the carrying amount of the machine should be written off, and impairment of 150 have been charged to profit and loss. This is the second impairment, 100, 200 plus 150, 200 plus 150 is 350. The recoverable amount of the ACCA cannot be determined, so therefore this must be taken for impairment as a part of cash redeeming. The total carrying amount of CGU after impairment of the pattern machine is this amount. So after impairment the value becomes this, whereas the recoverable amount is this, and further impairment of this 300 is therefore required. So this first look at the goodwill and then to other as a product of this. No further impairment should be related to the machine as we already mentioned. Like this, you see here, this is the actual impairment. You see 100 is the goodwill, so we have to impair this to nil, then pattern to nil, and this machine is revised value be this because after deducting the half of the thing, and in computer and building should be on pro rata base. Okay, so the recoverable amount is 1950, which is this amount, and this is the carrying value. So when the carrying amount is more than the recoverable amount, there is impairment loss, and the impairment is 300. Okay, the question is very simple, no need for. Okay, so here we have other things as impairment if reasonable equation is impossible. If there is reasonable equation is not possible, then you will go for let corporate asset like head office, building, research centers, and goodwill is not possible. Then the cash unit must be tested for impairment together in 2 stages. So you should go for impairment testing in 2 stages. The first stage you will just review the individual unit for impairment, and the second is comparing the carrying amount of the business as a whole, including the goodwill, with its recoverable amount. If you see here, example is an entity acquired business comprising 3 cash rate unit DEF, but there is no reasonable way of allocating goodwill to them. So after 3 years, the carrying amount of the and the recoverable amount of the net asset in the cash unit will be like this. You see carrying amount is per D is this amount 360, and this is the goodwill impairment, and this is the total amount. Recoverable amount is this. So if you see here, the 360 recoverable amount, carrying amount is greater than 360. So there is 60 of impairment. Okay. Now what you will do, review the individual unit for impairment. So first we will review the individual. The individual, there is no impairment, but here we have some impairment. Here no impairment, no impairment. The impairment is 60, and we will reduce the carrying value to this amount 360. Clear? And this will be recognized in the profit or loss. The second step, what you will do, compare the carrying amount of the business as a whole. So we will compare the whole business amount, and if you check here, 240, 360 plus 360 plus 150, it will become 1110, tetra zero. So you see here, this is the amount, total amount, and we will reduce the 6, which is the impairment. It will give this amount, and now we will compare this amount with this amount, mean 110, which is the carrying amount of the business as a whole. We'll compare this to the recoverable amount, which is 180. So here we have again 30 of impairment, which is recognized in respect of the goodwill, okay, and the profit or loss. Now let's move on, and we have some other question. Reversal. Reversal of impairment loss, we have already discussed this thing before. That if we have cost model, then to what extent we will reverse, and what about that if we have revaluation model. So in calculation of impairment loss is based on the production. What is the service? Fine. Impairment assets should be reviewed at each reporting date to see whether there are indications that impairment has reversed. So what you will do, impaired asset, if there is impaired asset, you should review at each reporting date. And why we are doing this impairment asset review? Because we want just to check that is there any reversal of impairment. The second thing you will do is that the reversal of impairment you should directly recognize in profit and loss is a gain, is income, is a gain in the profit or loss. If the original impairment loss was charged against the revaluation surplus, it is recognized as the company's income and credited to the revaluation. And we have done a question where we have 10,000 of revaluation balance of that specific asset. So the impairment loss first we debit that 10,000 amount. We did like this, I think. We did profit or loss, then we debit revaluation reserve and credit the profit or loss. This is the entry for reversal if we have some revaluation balance of the specific asset, and that was 143 like this and 153. Clear? And this is about that to what extent you will recognize the reversal, impairment reversal. So we have in cost model we have some borderline, that is a historical cost value. And revaluation, you should reverse it to the extent of the book expense in the past. Depreciation charge for the future period should be revised. We should revise the depreciation charge for the future period to reflect a change in the carrying amount. Okay, this is about the reversal. Here we have question, a boxer question. In the boxer question, a boxer purchase, what was this requirement? Explain with the supporting computation the impact on the financial statement for 2 impairment reviews. Okay. Here we have a question, and there is a boxer purchase a non-current asset on 1st Jan 2001 at a cost of $30,000. At that, it has estimated useful life of 10 years. So the useful life, the cost is this month. But then revalue this type of asset, but account for it on the basis of depreciation historical. So use cost model. At 31st December 2002, the asset was subject to impairment review and had a recoverable amount of 16,000. So what happened? What happened actually on 1st Jan 2001? The cost is 30, okay, and useful life is 10. So it will become like, let me take a calculator. So 3000, I think 30 multiplied by 10, it will be 3000. This is the depreciation for 31st December 2001. Then 3000 depreciation for the 31st December 2002. So it will become 30,000 less 6,000. It will give rise to 24, I think 24, and we have some recoverable amount on that date is 16,000. So there we have impairment of 8,000. Clear? This is the impairment on the 31st December 2002. Clear? Now at 31st December 2005, circumstances was caused the original impairment to be recognized have been reversed, no longer applicable. So recoverable amounts move on. Here is the thing. Okay, now you check here is a question answer. What happened? What happened is that 16,000. The 16,000 was the NBV at the 31st December 2002. Now we will just calculate the depreciation on the remaining useful life. So it will become 16,000 divided by 8. We will get 2,000. Okay, and this is for year 2003 and 4 and 5. So 2000 what? Okay, 2000 and 2000. So it will be like 6,000 depreciation till this date. Okay, so if I write like this, that NBV at 31st December 2005 will be 10,000. Clear? And the recoverable amount on the same date is 40. Okay, now what we will do, we need the reversal of this thing. Clear? So if we have not, if there is, let me go here. Okay, if there is no depreciation, so we will just calculate the carrying value, and the carrying value, how you will calculate the historical what we call that historical carrying value. So historical carrying values means if there was no depreciation in the past. So what you will do, you will do just let me check here the cost. The cost is 30,000, and the total useful life is 10 year, and 5 year from 1st Jan to 31st December will be 5 year. So at 3,000, if we divide 30,000 by 10 years, multiply by 5 years, then we will have 15,000 as the depreciation of the historical, and at 30,000 okay, 30,000 less 15,000 the depreciation, so we will have 15,000 of historical carrying value. So what you will do, the recoverable amount, which is how much? 40,000. So this 8,000 reversal, the whole thing, the whole amount is not possible. According to IFRS 36, the reversal of is limited to 5,000, and you know how this is the 15,000 historical carrying value and less the carrying value, which is 10,000 we have calculated here, and it will give 5,000. So the reversal of 5,000 is possible. We will, okay, let me check here. Let me do this in a clear way so you will understand what does it mean. Okay, let me check right here. On 1st Jan 2001, the cost okay, let me do it again. Okay, the question is a little bit tricky, not tricky, but okay. On cost is on 1st Jan cost is 30,000. Clear? So depreciation will be like 30,000 divided by 10, okay, and multiply with 2. So it will be 2, I think 2, yes. 30 by 10 multiplied by 2, so it will be 6,000, okay, for 2 years. This is for 2 years. So on 31st 12 2002, the NBV will be 24,000. On the same date, the recoverable amount is 16,000. If you see here, this is the recoverable amount. Okay, so impairment is about 8,000. This is the impairment. Now what happened? At 31st December 2005, the circumstances which caused the original impairment to be recognized have been reversed. So mean this amount is need to be reversed. What happened till 31st December 2005? On this 16,000. Okay, this 16,000 we will divide with the remaining useful life. So 2 years already passed, we have 8 years now, and this will be, what is the depreciation? This is 16,000 divided by 8, so it will be 2,000. It will be 2,000. This 2,000 is for 2003, and then 2,000 for 2004, and then 2,000 for 2005. So it will become 6,000. So at 31st December 2005, carrying value is equal to 16,000 less this 6,000 amount will be 10,000. So this is the carrying amount at this date. Now the recoverable at this date is 40,000. So if you check that historical carrying value is equal to 30,000 divided by 10, and this is the 5 year. So it will give rise to 15,000 depreciation, and carrying value will be like this: 30,000 minus 15,000 depreciation, so it will be 15,000. This is historical carrying value. Now what you will do, 15,000, so this is the border, 15,000 less 10,000 NBV, it will give rise 5,000. So you will reverse till 5,000, not more than that. So what you will do, you will debit property, plant and equipment with 5,000 and credit profit or loss by 5,000, and this will be the income. Clear? And the asset will be carry at 10,000, which is the carrying amount. So we have just, this is the border, we have not to cross that, and we already discussed this before. Here is the equal thing. Okay, this is this asset carrying value is 16,000, so it will, after depreciation, it will become like this because we have deducted 2,000, 2,000 and 2,000 for 2003, 4, 5, and this is recoverable amount. So there is no impairment loss, we need to reverse. So there has been no impairment loss. In fact, there have been a complete reversal of the first impairment loss, which is 8,000, but we cannot reverse the whole amount because we have to reverse till the historical carrying value, and the historical carrying value is 15,000. So the 15,000 less NBV, which is this amount, it will give rise to 5,000. So we will only reverse the 5,000. The reversal of the loss is now recognized, and the asset will increase by 5,000. So 15,000 less this amount, and the gain loss, this will be recognizable. So I have just put entry like this: debit PPP by 5,000 and credit profit or loss is an income by 5,000. This asset is increased by 5,000, and again 5,000 is recognized as profit or loss. It should be noted that the whole 8,000 original impairment cannot be reversed. I told you before that there is some border, we have not to cross that border. The impairment can only be reversed to a maximum amount of depreciated historical cost, which is the historical carrying value based on the original cost, estimated useful life. Okay, now we have another question about yes, this is another question, is the CGU impairment reversal, and explain with supporting computation the impact of the impairment reversal on the financial asset of the year end on 31st December 2003. So on 31st December 2002, the impairment review was conducted, cash net unit and result. So this is an impairment review, and we have just the impairment loss of 220. So the property, plant, equipment was originally purchased by this amount. So property, plant, equipment was originally purchased by 400 and on 1st January 2001 and was attributed 8 years. This is useful life. On 31st December 2000, the circumstances was caused the original on after 2 years, after 3 years. The value is a recoverable amount is greater than that of the carrying amount of the cash generating unit, so there is no impairment. So what you will do, I told you before that there is no reversal of the goodwill. Let me show you here. I think we have discussed here. Where is the thing? Okay, here you see impairment loss recognized for goodwill cannot be reversed in the subsequent period. So once the impairment loss recognized against the goodwill, so it not be reversed. The first thing is, so cannot be reversed. Impairment of the property, plant, and equipment can be reversed. How? There is a limit that we have done before, and the carrying amount of the PPP and and 41st in 150, so this will be this amount. And if the property is not impaired, then the value is 31st December has been this amount. Okay, let me show you in a simple way. Okay, in a simple way, what is the thing? The first thing is the impairment of this amount. This is actual impairment. So 100 is actually the goodwill which has been written to nil. No need to rewrite again. Let me write here for property, plant, and equipment. So the property on the first 1/1/2001, the value, the cost is actually 400. Clear? Now this is for 8 years, so if you divide by 8, so you will get 500 depreciation for the year 1. Okay, and for the second year you will also get 5,000, and then you will have the carrying value on 1/1/2003. The carrying value will be 300. Clear? This will be up to here. Now on the same date, on this date, on 1/1/2003, the recoverable amount of the property, plant, and equipment is 180. So it means there is a depreciation, impairment of 120. This is 180, 300 less 180, so this is impairment of this amount. Now 180 is divided by how much? 2 years already passed, so the remaining year is 6. So in the 6th year, for 1 year you will get 30,000 depreciation. Okay, now the question is asking at the 31st December 2003. So 180 less 330 depreciation. So the NBV on this date, the year 31st December 2008, will become 150. This is the NBV at this date. Clear? But on the same date, the recoverable amount is go off. And that is 4,200,000. So there is a need of reversal of 270. Okay, let me erase this thing if you have been written. Okay, so if you see here that the NBV at 31st December 2003 is how much is 150, and the recoverable amount on the same date is 42 is his given is here, this amount. So 270 reversal is required. Clear? And I told you that requirement to reversal is to the extent of historical carrying value. So how you calculate the historical carrying value? Historical carrying value is the value that impairment has not been occurred. So if I take this 4,000 and divide this by 8 and then multiply it with 3, because 3 here is there, so it will give rise to 150. So this will be 50 and 50 multiplied, so 150. So 150 is the depreciation. So on the same date 240,000 less 150, it will become like 250. 250 is the in historical NBV. So this is actually the borderline. Okay, this is 250 is the border line. You cannot cross this thing. Clear? And here the NBV is now 150 on this date. So 150, it will give rise to 100. This 100 is PPP divided by 100, increase by 100, and the property is income gain by 100. Okay, this is the equal reversal. Clear? Now let's move on. We have another question, and this is a simple question. You can do it by yourself. Okay, Peter own 100% of equity share of this company, blah blah blah. Okay, here we have. So what we will do first, on the reporting date, fire within this building is the impairment review carried out. The recoverable amount of business, this is the recoverable amount. This is a carrying amount. Recoverable amount is 9900. And the fire is the sum of the plant equipment. So carrying value of the billion, carrying value of the plant equipment. This amount goes down to 15400. Carrying value Duna. Okay, let me do it for here. This equipment with a carrying value, this more with no option, but it's scrap. Or the remaining plant was worth at least carrying value. So okay, let me write for you guys here. If you see here, the goodwill is, this is the goodwill, and then building, then plant and equipment, then other intangible, and then receivable and cash. So here goodwill is 24, then 6,000, then 5, and then 2,000, 1,400, and then we will have 17,000. Okay, the recoverable amount is 9885. Clear? This amount, because we don't need to no need for impairment because it's realized in full, so that write 4. Fine. The goodwill is okay, first we have to calculate what is the difference between the carrying value, the difference between carrying value and recoverable amount, which is about 7,200. This is impairment loss, and this amount, the whole goodwill should be written down to nil. Clear? One thing more here is that the recoverable amount of the business was determined is this, and the fire destroys some of the plant, and the carrying amount of that plant is 12. So we have just deduct 1200 from this plant and equipment. So it will, I think this is 4,000. Okay. What other thing is here? This fine. This is done. We have done this. Okay. Here the other intangible consider license of company. The following scrapping some plant and equipment competed upper to purchase the patent at this amount. So the patent actual amount is 2,000, but now the value of this patent is 1,500. So mean there's a amortization. There is a impairment of 500. It will become 15. So this is now the recoverable amount, 1,500. Okay, we have just finished, and for the remaining, we will do. I see both state realize. You see this, the receivable and cash both will be realized value and do not require data impairment. Now if you see this 7,200 list 24, which is the goodwill value, and then 1200 and then 500. So you will have 31,000. Okay, now this 31,000 should be allocated to this building, and you will get here 2900. So 29,000, 2,900, 400 and 1,500, it will become 9,298. So this is the recoverable amount. Now you see here the theoretical part of this question, some calculation. The plant equipment is reduced in value by to 40,000 because this amount is already destroyed, and it has been specifically impaired the following instruction of the file. The second thing is goodwill is fully impaired and written down to nil. We have just written down into nil. We have just did this, and now the patent is reduced to this amount because it's the recoverable amount, and the remaining. Okay, fine. This is easy peasy question. You can do it by yourself. If there's any problem, then you can ask me. Now we have some here a question. This is just for simplicity. Reversal of impairment. So if we are using, let's say, cost model, and we have asset, and the asset value is cost is 100,000 and the life is 10 years. So after 1 year the depreciation will be 100 and NBV will be 900 because 1,000 less this amount, 100 will become. Now on this, after 1 year the recoverable amount is 630. So there's impairment of 270. Clear? So this 270, this is the impairment loss. Now we will depreciate this 630, this is recoverable amount, by 9 years. If we depreciate this by 9 years, so we will have 70 for the second year and then 70 depreciation for the third year. After third year, the NBV, which is 630 less this depreciation, it will become 490. Okay. After third year, the NBV is 490 and the recoverable amount, which is goes up to 580, mean there is no impairment. So we will need to reverse the previous impairment, which is 270. But to what extent we can do this? Let's check it. This 90,000 debit property plant equipment by 90 and carrying credit from property losses again by 90. Okay, what will happen if this recoverable amount, which is 580, is not 580 but 760? Then reversal then the reversal which is allowable under IFRS 36 is 240. How? Because this is the borderline. If you see here, this 1,000 divided by 10 and multiplied by 3 after 3 years, the depreciation will be 300. Okay, so 1,000 less 300, it will give rise to 700, and this is the historical carrying value, which is the borderline. You cannot cross this. So 700 less 490 MBV, the current MBV, so you will get this amount. So you should you will reverse the impairment loss to this extent, not the whole amount. Okay. Okay, if we have some we are using revaluation model, then what you will do? The same thing is the cost. Let's say I have told you before that in case of revaluation model, you will reverse till the expenses booked in the first. So here, let's say we have a cost of the asset 1,000 and the depreciation life is 10 years, and we depreciate at year 1, so it will become this amount. NBV at year 1 is 900 and the recoverable amount, let's say, is 720. So we have impairment loss of 180. This 180 will be recognized in profit and loss, and property plant equipment is reduced by 180. Now the property plant equipment is depreciated over 9 years, I mean 10 minus 1, so it will be 9 years. We will have this depreciation on the next year, and after second year we will have NBV of 40, because if you deduct 720, if you deduct 80 from 720, then you will have this amount. Now let's say we have on after second year, on the second year we have the fair value is 12, so there is no impairment because because the recoverable amount is greater than NBV. So there's a revaluation of 560. Clear? Now we have to reverse the previous 180 impairment. So how you will do? The first thing is the property, plant and equipment is debit. Okay, we had just debit the property and equipment by this amount, which is equal amount, and we will credit the revaluation by 4,000, and then credit the property, plant, the previous impairment by 160. And you know why we not use it? Because we have there's some reduced depreciation, and the reduced depreciation if you see in year 1 we have depreciation 100, but if you see in the second year depreciation become 180, so there is a reduction and depreciation by 20. Okay, reduction and depreciation by 20, and this amount is deducted, and the remaining will be credit because income to the because we already take this advantage, so no need for including this here. Okay, and reverse in property plant by 180 less reduction by 20, and so the remaining amount this will goes to the profit and loss. And if you remember, I have told you at the start where I think, let me show you so it will be clear to you that how the reduction is included in the okay, here if you see, and revaluation model, reversal is possible till the extent that you have booked expense and past with inclusion of the effect of reduction. So the expense we have booked is 180, but there is a reduction of 20 is a depreciation, reduced depreciation effect, so we have reversed till 160 only. Okay, and at the last we will just talk about the disclosure of the impairment. Where is the thing? Here. This is the last thing, disclosure. IFRS IAS 36 required disclosure of the following. The first thing is impairment losses recognized during the period. We should disclose impairment losses recognized during the year, and we should also disclose the impairment reversal recognized during the period. Okay, if there is material loss or material reversal, then for that you have to disclose the amount of losses and reversal and the event causing it. And the second thing is recoverable amount of the asset and cash generating unit. And the third thing is the value level of fair value hierarchy, because under IFRS 13 there is a step, there is a level through which you determine the fair value cost to sell. So you should also disclose the level. And the fourth thing is you should also disclose the discount rate. So this is the end of this IAS 36. And the next lecture we will discuss about IFRS 5. Okay, so goodbye.